Welcome back to the channel. In today's video, we're going to be going through 3 proven exit strategies that you can use to reduce capital gains taxes when you sell your rental property. And stick around to the end because I'm going to be doing 2 honorable mentions that you're not going to want to miss. If you do like this video, make sure to hit the like button as well as the subscribe button and the bell icon so you don't miss out on future tax savings videos. And also, if you do have any questions, go ahead and drop me a comment. I'm going to answer as many questions as I can. But without further ado, let's go ahead and just dive right into the first strategy. And the first strategy is going to be the 1031 exchange, which I believe to be the gold standard of real estate exit strategies. So what the 1031 exchange allows you to do is allows you to defer your capital gains taxes when you sell your property and reinvest the proceeds into at least one other property. Now, before I get any further into this, you might be saying, well, Tom, this isn't really reducing taxes, this is deferring taxes. And you are correct. But there is a value in deferring your taxes, and there's actually a way you can eliminate taxes using this strategy, which I will touch on. Okay, so deferring your capital gains taxes allows you to take the proceeds or the money that you would have otherwise had to pay the IRS and state governments if you're subject to state taxes and use it to continue to build your wealth and keep that money working for you, right? If you pay the IRS, let's just call it $100,000 in capital gains taxes, well, that could be worth up to $400,000 of additional purchasing power if you are using traditional financing or just financing at a 75% LTV or loan to value ratio, which is pretty common, at least in the single and small multifamily space. All right, so that's the power of deferring. You're able to keep your money working for you today. All right, now let's get a little bit into how the 1031 exchange actually works. So when you sell your rental property, you need to basically buy another piece of real property. So you can't 1031 exchange from a rental property into a syndicate or fund, although there's a way you could kind of do that, and I'll also mention that in a bit. But it's real property for real property. Also, when you sell your property, you cannot take possession of the sales proceeds. You need to work with a qualified intermediary, also known as a QI. They basically hold the sales proceeds in escrow and then distribute it when it comes time to buy the new property. Again, if you take possession and you don't work with a qualified intermediary, the 1031 exchange will be dead on arrival. So super critical that you get a QI involved as soon as you start considering the strategy in a serious way. It's also really important to note that you have 180 days from the date you sell your property to acquire at least one or more of the properties you identify. Now, within that 180-day window, the first 45 days is the period that you'll have to identify up to 3 replacement properties or properties that you'll want to replace your sold property with. Okay, so it's a total of 180 days and then 45 days, the first 45 days to identify up to 3. All right, so that's another critical piece. If you fail to identify properties within 45-day window, 1031 exchange is dead. All right, if you fail to close on at least one of those properties within the 180 days, then your 1031 exchange is also dead. So it's important to keep in mind of these deadlines. Now, I also mentioned that it is possible to eliminate your capital gains taxes using this strategy. And the way you can do that is basically as you go through your real estate investing journey, you continually use the 1031 exchange over and over again every time you sell a property. And then what happens is when you pass away, and I hate to be morbid, but when you pass away, you can leave your properties to your heirs and they'll receive it. They call it a step up in basis at the fair market value at the date of your death, effectively eliminating all the depreciation recapture and capital gains taxes that you would have paid had you sold in your lifetime. Just give a quick example, and I'm just using broad numbers here. All right, say you purchased a property for $1 million in 2024, and then you passed away in 2075, and you have a $15 million property because you continued to use the 1031 exchange to trade up over time. Then what would happen is your heirs would receive the property at the date of your death at the fair market value of $15 million, eliminating all the capital gains taxes you would have paid. So it is possible to use this strategy to eliminate capital gains taxes when you combine it with the step up in basis and pass the properties down to your heirs. I also mentioned that it's possible to do to 1031 exchange kind of into a syndicate or fund so that you can take a back seat and not have to be involved or be responsible for the management and oversight of a property. And the way you could do that is with a Delaware statutory trust, also known as a DST. And what a DST is is a vehicle that the IRS blessed effectively as real property for the intents and purposes of a 1031 exchange. So you sell your property, you invest into the DST, and the DST typically invests in Class A properties like a Walgreens or a Dollar General that's on a triple net lease. And basically, is managed by professional property management and professional operators. So you don't have to worry about and be responsible for those day-to-day operations. And that allows you to take a back seat. So it's not quite a syndicate and fund, but it's a very similar structure and achieves the same goal. Now, I know someone's going to comment this out there, so I'm just going to address it head on. There is actually ways you could 1031 exchange into a syndicate or fund, an actual syndicate or fund. But the way this is done is what you 1031 exchange into the actual property that the syndicate and fund is investing in alongside the limited partners. All right. And this is complex and a costly strategy from a legal perspective. It comes with a lot of downsides for the sponsor or the general partners that are running the deal. And oftentimes is not really a viable solution. So the DST is a more viable option if you do want to go passive. All right, so that's a 1031 exchange. And the last thing I'll say on that is that there are variations of the 1031 exchange, including the reverse exchange, where you sell your property, where you buy the property, you buy your property first, you buy the replacement property first, and you later sell your property. But it comes with complications. So you're going to want to make sure you're working with a qualified tax advisor as well as a qualified intermediary to make sure you execute that transaction properly. But again, 1031 exchanges, the gold standard, probably my favorite exit strategy for real estate investors. Now we're going to move into something called the lazy 1031 exchange. Now, believe it or not, the lazy 1031 exchange actually does not have anything to do with a 1031 exchange at all. However, it does get you similar benefits, which is why it's been dubbed the lazy 1031 exchange. And here's how it works. Basically, what happens is you sell your property, generating a capital gain, and then you buy another property in the same tax year. Okay, so the same year you buy another property, and then you use a cost segregation study and bonus depreciation to generate non-cash losses, they're usually passive, to offset the capital gain. Okay, that is the strategy. Now, a few caveats here, a few nuances. You don't actually have to sell your property first. You can buy a new property and then later sell property as long as it's done in the same year. So for example, you could buy a property in January, sell property in June or September or any month in the same year, and you'll be able to execute this strategy. Additionally, this strategy does use passive losses. So you might actually already have suspended passive losses from prior years that you can use to offset capital gains, and you may not have to buy a property, or maybe not have to buy as big of a property as you thought. So the way you determine whether or not you already have existing suspended passive losses is by looking at Form 8582 on your most recent individual tax return 1040, or Form 1040, to see if you have existing passive losses. If you already have enough to offset the gain and depreciation recapture on the sale of your property, you don't actually have to go ahead and purchase a new property. So that's just a win. Or you might have some, but not enough. So you just have to go out and purchase another property, but maybe it's not as large as you originally thought, which allows you to keep some more money in your pocket and use for other things. So that is the lazy 1031 exchange in a nutshell. Now, I will put a caveat on this, or an asterisk, that this strategy does rely on bonus depreciation. Right now, as of the recording of this video, bonus depreciation is 60% in 2024, but is set to phase down to 40% in 2025 and 20% in 2026, and in 2027 it is eliminated. All right, so as the years go on here under the current law, this strategy will become less and less impactful, making the 1031 exchange the more viable option, and definitely the option that you'll want to consider if this strategy is not going to be potent for you. The last thing I'll say on that is that now, one more thing I would want to add in there is that we do expect bonus depreciation to be extended in 2025 with new legislation. But right now, it's just all speculation. And until the bill is actually passed, we won't know. So always keep that 1031 exchange in mind. Now, we're going to move along to the final strategy we're going to mention here today before we get into our two honorable mentions. And this one is investing in a qualified opportunity fund. Now, a qualified opportunity fund is a vehicle that was put in place in the 2017 Tax Cuts and Jobs Act that is intended to revitalize low-income areas. So we have opportunity zones across the United States, and if you invest in the opportunity zone, and use a qualified opportunity fund, then you can defer your capital gains taxes until 2026 and also potentially eliminate the capital gains taxes on the QOF investment itself. So what do I mean by that? So here's some of the mechanics, and that'll kind of explain how this works. So you sell your property, and you typically have within 180 days of selling that property, similar to a 1031 exchange, to invest the capital gains. It has to be capital gains. It cannot be cash. You will not get these benefits that I'm about to explain if you invest cash. While you can invest cash, you're not going to get the tax benefit. So it has to be capital gains, and you invest into a qualified opportunity fund, and you'll defer your original capital gain from the sale of your property until 2026. Now, when 2026 happens, your capital gain will come due and you will have to pay taxes on it. However, and this is where the real power of this strategy comes in, if you hold your QOF investment for 10 or more years, you will eliminate the capital gains taxes on the QF investment itself. So remember, you're taking your capital gain, you're investing into this vehicle that's investing into these low-income communities, often investing in real estate, and then presumably that's going to increase or appreciate in value over time. And if you hold it for a minimum of 10 years, the gain on the qualified opportunity fund investment itself is eliminated, and that could be substantial with the right investment. So this is a qualified opportunity fund. It's another very impactful strategy. So it's something you're definitely going to consider when it comes time to sell your property. If you do have questions on this, drop them in the comments. Now, I do have two honorable mentions here. I do want to mention one of them is going to be tax loss harvesting. It's not the sexiest of strategies, but it definitely is definitely a strategy to consider. And that is where you sell capital assets that you have, such as stocks, bonds, real estate, and perhaps cryptocurrency or other assets at a loss, right? And when you sell them at a loss, this capital loss can offset the capital gains on the sale of your property. Now, the reason why I'm not a big fan of this strategy is because it requires you to sell assets at a loss. Now, if you have assets that are unlikely to recover, maybe it was just a bad investment or something happened in the market and it's just, it doesn't look good, it's not going to come back. Selling that and locking in that loss can have some benefit from a tax perspective. But again, you have to actually sell assets at a loss, which may not always make sense or may not always be part of your portfolio. You might not always have that available. This is reason why it's an honorable mention. And the other honorable mention that I will bring up today is the installment sale. So the installment sale, is also known as seller financing. And that's when you sell your property and you act as the bank. So you basically give your seller a loan, your buyer, a loan, and then they pay you back rather than going to the bank. All right. And what that allows you to do is allows you to spread out your capital gains taxes over a number of years, and you don't have to recognize it all in the same year. And that can actually help you reduce your taxes by keeping you in the lower capital gains tax bracket in some cases. So for example, in many cases, when you sell, you might be subject to the 15% capital gains rate. But if your income goes above a certain threshold, and that's going to vary from year to year, it's right now and going into 2025, it's going to be roughly around $600,000 if you are married filing joint. I think it's around $533,000 if you are single. You're going to jump into the 20% tax bracket. So by spreading your capital gains taxes out over a number of years, you could potentially pay capital gains taxes at a lower rate, which could help you save taxes. So those are the tax strategies that can help you reduce taxes. It's not a comprehensive list. There's certainly some more. If you do want more tax strategies like this to help you reduce taxes when you sell your rental property, drop me a comment. Let me know. More than happy to go through more and do additional videos on exit strategies. And also, if you do like this video, make sure to hit that like button, the subscribe button, and that bell icon so you don't miss out on future tax savings video. And last but not least, if you are looking for a CPA to help you navigate exit strategies or help you come up with a tax plan in general for your situation, help you reduce taxes, we do accept clients. You can click the link in the description below to request a free 30-minute discovery call to see how we can help you reduce your taxes. Thanks for watching, and I'll catch you in the next video.